Welcome back. Stocks are lower this morning. Futures indicating a decline at the start of trading ahead of the November jobs report out at 8:30 a.m. Eastern. Fractional moves, Dow Industrials down 45, NASDAQ down 23, but economists are expecting growth. They're expecting 200,000 jobs added to the economy in the month of November, with the unemployment rate holding steady at 3.7%. Joining me right now is the co-founder and president of Macro Intelligence 2 Partners, Julian Brigden. Julian, great to see you. Thanks very much for being here this morning. What are you expecting from the jobs market, and how do you assess the macroeconomic story right now?
Well, good morning, Maria. Yeah, I mean, Friday is always a bit of a tough one. These non-farm payroll numbers are always a little bit tough to estimate, a bit of a crapshoot, to be brutally honest. In particular, because we've been seeing some very large seasonal adjustments over the last few months from the BLS. Who compile this data, and it's running about 300,000 above where it was, or it would be in a typical year. So I think we're due for some weak numbers. ADP was weak this week, much weaker than expected when they came out with their jobs data. And if we look at our forward indicators, Maria, we're starting to see job cuts towards the end of Q1 and into Q2 as we see this economy slow and as we move into the recession. Yesterday, for example, we had ISM manufacturing at 49. That's below the level where typically the Fed cuts because we're moving into contractionary territory.
Yeah, really interesting to see this jobs market hold up the way it has, even with the Federal Reserve's aggressive tightening. I mean, the Fed is holding its last meeting of the year in just 2 weeks, less than 2 weeks. We're expecting the bank to raise rates by 50 basis points, Julian, because they actually have already seen a real impact in terms of demand destruction. How bad are things going to get? How weak are you expecting 23 to be with all of these rate hikes?
Yeah, I mean, I think you're absolutely right, Maria. We talked about it last time we were on the show. I mean, they're downscaling because they're starting to see things succeed. And I think if you look at Powell's last speech, it was almost a speech of a man who thinks mostly his job is done. I don't see that as bullish because I think his job, unfortunately, is to get us into a recession. That's essentially what's priced into the Fed forecast with their rise in unemployment. I think we are looking at a pretty weak 2023. We've got a significant inventory overhang in the manufacturing sector, not just in retail, which obviously we've been talking about for a few months, but manufacturing, that was very clear from some of the comments yesterday in the PMIs. We have got the same issue in housing, where I think we're going to see a very, very significant drop in construction, which typically is a very good canary in the coal mine for the US economy. And I now think we're seeing a tightening of broad credit standards right from the banks. So I think we really are looking at probably a recession, I would guess, starting in Q2 of next year. And at this stage, I mean, it really does depend to a certain degree on how the equity market responds on this, how deep it is. But there's no question that we are getting a recession.
Well, look, you've got OPEC meeting on Sunday to possibly cut production to push oil prices higher. You've got interest rates plummeting. Look at the 10-year, down 9 basis points today, sitting at a level of 3.5%. What are markets telling us?
I think look, when we were last on the show at the end of October, we said that for the first time in 2.5 years, we thought the bond market looked attractive. And yes, as you said, yields have continued to fall. I don't think that's good news, Maria. I really think that it's the bond market sensing the recession is coming in an unusual environment, I think, where the Fed will hold rates here on hold for much, much longer than the market thinks. We've never raised rates, really, despite all his supportive talk about Paul Volcker and how, Powell likes Paul Volcker, et cetera, he did a great job. He hasn't got rates anywhere close to those sorts of levels. So they're pursuing a policy, really, where they have to hold rates at the front end very much sort of high for a long, long time. And that really means that the long end of the bond market has to do most of the adjustment. And that's why I think it's rallying and we're seeing yields fall, because that's where the bond market is pricing in the recession.
Yeah, you wonder when this hits earnings, how significantly it hits earnings and ultimately the stock market. I'm with Chris Markowski today. Chris, jump in.
Well, it's interesting. You're talking about going into a recession. We're almost there. If you take a look year over year, we're basically flat when it comes to economic growth. And if you actually, factor in the inflationary aspect, 7-8%, we're kind of going backwards to some degree. I'm trying to price this, obviously, every single day into the equities markets. And I'm actually seeing, in my opinion, a good sign. You're starting to see certain companies out there cut their workforce, cut their costs down there. And the reality is, like Larry Kudlow always says, it's stock price all about earnings, and that's the mother's milk of the entire thing. Will companies be able to hold on to these earnings?
Julian.
Yeah, I'm sorry. I'm not sure it is. I think we've had this very unusual situation in the US where companies have faced huge cost increases, but were able to pass it on because you had this incredibly robust consumer courtesy of all the stimulus that we got. I think when I look at savings rates that have dropped to historic lows now, as people have spent what they had in the piggy bank, and secondly, I look at this tightening of credit, which I'm starting to see percolate, that suggests to me that their ability to dip into sort of credit cards to keep the game going, I think is actually beginning to fall. And in those PMIs, you started to get a sense that some of the price cuts that we're seeing and some of the reduction in inflation, which is welcome though, is becoming because companies are starting to see weakness in demand. And that's what worries me. I'm not sure that we're going to be able to see those margins maintained at that level.
And typically you would expect to see that in the oil market as well. Lower prices as a result of expectations of weaker demand. So we'll be watching that. Julian, it's good to see you. Thanks very much for weighing in on that. Julian Brigden joining us this morning. Thanks, sir. Have a good weekend.